Push and pull of bulls and bears continues, but common market saying goes. Bull market is climbing on the wall of worry. So even though the margins remain at risk as inflation softens and economic growth slows, growing skepticism might be the fuel for growth. Latest technology earnings also energizing the bulls. So that's fine, but EURUSD par that is a litmus paper of risk of sentiment is approaching a 5-year resistance boundary coming from a giant symmetrical triangle. We'll get to that in a second. So the party may be ending soon, as we do know that it's very difficult to get through such a long-lasting resistance. But we may enjoy the party while it lasts. But bear in mind that times like this, especially at the ends of long-lasting trends, when risk of environment aggressively turning on, hype is usually the biggest. And this usually sparks many speculative stupidity with attempts to shit in you some fundamentally looking shit via social media. So don't trust but verify, or if you don't have experience, Blockrevision might do it for you. So no worries, we are not here to look for a get rich quick schemes. So we'll tell you just about certain probabilities, particular elements that influence and interoperate with each other coming out of different circumstances. So don't hesitate to ask questions if you have such. So today we are going through economy view right after market outlook and ending up with economic calendar, earnings season and trade idea. So let's head on. All right, so economy view is the one of the section that we are going through right now. What's happening underneath the economy? What has an impact on global market? So I will get you to Bloomberg, and at first let's talk a bit about this EURUSD. So let's at first maybe look at chart. So in terms of EURUSD, on a weekly chart, we can find that we are right now at the lower boundary of this symmetrical triangle that started forming back in December 16th. On a weekly chart, it looks even better. So we can find that this exactly symmetrical triangle might be a stoppage for the euro bulls. So it doesn't mean that the bull market is ending right now in terms of risky assets. I wouldn't be so sure right now, as EURUSD has a tendency to get through those weeks, those monthly weeks, especially when this recent price action is really strong. So one thing I would like to look at right now is the thing how we will react within this area of 1.10 and 1.11. I guess 1.10 might be the one of psychological resistance and the one we need to watch at right now. On the weekly chart, we right now got through this recent resistance of March of 2020, and that means that we are looking for another. We need to look for another possible supply that may be somewhat an inhibition for the chart. Right now on the RSI index also, this rise in RSI without any interruptions of the way are indicating that this trend is really abnormously strong, and looking for shorts around here might be stupidity. So for USD, it's not only technicality that I would watch at 1.10 that may bring some supply pressure on the pair, but also we need to look at some fundamentals. So what about the next decisions of ECB that may impact euro valuation, stacking up other currencies? So ECB is seen delivering 2.5-point rate hikes on the way to May peak. So we can find that we still have some uncertainty in terms of where those hiking cycle in Europe may come to. Right now, in terms of US bonds, are assessing that it's more likely that the Fed will take a step aside, and eventually that may lead to the step back in terms of this acceleration and this recent acceleration process that took us over a year of hiking interest rates. But in terms of ECB, that's a bit more blurry. That's why we can find that the price action on the euro is right now favoring those that are for strengthening euro rather than against it. So let's have a look right here. ECB also is data driven, so it's everything depends on what the inflation gauges may indicate to us within 2 next months. It's February and March. Right now we can find that they cannot hike too high, as the high indebted economies might have trouble, so they cannot overextend this curve, but this level they just expect to being hit at around 4% is highly achievable. So the deposit rate right now is about to get us to 3.25% in May. It may get even further, but that's what the economists are predicting to happen. So normally we are still in the phase of maintaining the pace of hiking interest rates, and afterwards, maybe on the edge of April and May, this stoppage may be much more visible. So I would expect that Euro USD, getting back to chart, I would expect that Euro USD may eventually maybe even get to 1.10, and right after consolidate around this boundary, and afterwards, when this relative strength index get a bit lower, after will take a stronger brief in, I would say. So Euro USD is right now still in a upside mode, and it would be unreasonable to bet against it. You need to get updated on what may come next. So right now we're heading to some earnings season, and recently we've tracked very carefully Visa, MasterCard, and their findings on economy. So recently, spending on Visa's cards climbed 1.7% to $3 trillion in the company's fiscal first quarter, missing the 3.16 trillion average of analyst estimates compiled by Bloomberg At MasterCard, volumes jumped 11% to 1.73, also missing estimates. So those companies are right now, maybe if we jump to another section, so far both companies said inflation hasn't weighed on consumers' overall spending patterns. Instead, card customers have shifted their spending to lower cost items or generic brands. So it means that those, as yesterday's I've depicted, those credit card debts are rising, and alongside there's no much of a concern of customers recently, customers condition. So recently we've seen that even those companies' fiscal quarters are missing in both cases, we can find that the outlook for the next quarters is not as bad as the market initially has anticipated. So we can find that there's another component that taking off with this China rebounds. As we look at analyzing the quotation, as we look at the broader economy, we see the continued recovery of cross-border travel, with volumes up 59% versus a year ago, and we are encouraged by Asia opening further. So even with this deglobalization in terms of supply chains proceeding, we can find that the globalization in terms of tourism after this pandemic going away is still here, and we can find that we would be rather bet on that these elements of cross-border travel will accelerate during this year rather than tipping against. So in my view, this deglobalization in terms of supply chains may get somewhat extended due this year, but on the other hand, we may find this cross-border travel may compensate to some extent this consumer spending globally. So also this outlook is I would say, of no worries. And at the end of the economic view, that's one of the things that might get traction within next months or years to come. So OpenAI, and what I mean is about an insight in a new technological trend that may hit up another boost of interest by retailers, is this artificial intelligence trend. So we are talking about, for instance, that company that is called BuzzFeed, that which shares surged 120% on plans to embrace OpenAI, and we can find that those companies that may implement those solutions may, I would say, leap like hot potatoes when this trend right now is really getting very, very hot. A few years ago, it was electric vehicles alongside biotech and blockchain. Right now, the next booster for this volumes, market volumes, might be this AI elements being implemented to many companies. So just making you aware of being cautious of what may happen underneath, and we'll get you updated on the things to find out maybe some of the interesting stocks. And also Bloomberg is boasting with the news that it asked ChatGPT to make a market-beating ETF and they found that when they have asked of finding and of constructing an ETF that's uncorrelated with US stocks, what happened? There were bonds, commodities, real estate, and alternative investments. So we can find that those elements obviously add up to this uncorrelated portfolio, and that might be somewhat encouraging to many hedge fund portfolio managers. So whether it's ChatGPT or any other AI stimulated solutions, those elements may be more widely implemented. So many of those solutions are always based. What we need to be aware of those elements of recency bias. So they assume that what happened in the past is supposed to happen in the future, but those elements are also kind of are prone to some educational and improvements, adjusting their parameters to the changing circumstance. So that might be somewhat positive in terms of returns in the long run, but we need to always be very cautious, as we don't know or don't get very easily how those chat GPTs or other type of things and gears is working fairly without understanding the code underneath. And I guess 99.99% of people won't get it. So we need to be very cautious indeed. So if we just rely our whole balance and our portfolio on this ChatGPT's sectoral knowledge, we might get really troubled, as those elements may not really comply with our needs. So I'm just making you aware that betting on AI type of constructing portfolios might be tricky and also quizzical in some ways. So always better educate yourself before taking anything of those different type of technological innovations that are not yet been so profoundly benchmarked and tested. So we are right now heading into another part. It's an market outlook, and for this one I will get you to what's happening on SPX. So right now on the weekly chart, we can find it we are rebounding on a satisfactory volume, but what I would like to see is maybe even higher volume. But weekly candle is building right here that resembles a sorry, I haven't switched the window, my bad. But we are back. So what I wanna see right here is this weekly candle on SPX after crossing this downtrend line to maintain, and that might be an optimistic feature for next week's rise until 2nd of February, where we have this Fed's meeting taking place. So by Thursday, I do expect those major indexes may rise to at least level of 4100, and that's where we may find a major supply coming up. So by and large, indexes may look fine next week. For this and the majority of next week, we are jumping to market movers section,